The one thing that's kind of interesting as well with the secondary and the spreads and what have you is that everything prior to the crisis became homogeneous in terms of all the yields were the same for all the sectors in every market and sub-market, and broadly across Europe practically you'd say there's a 100 basis point spread for Central Europe, and so everything was the same in Prague and Warsaw, and so I think there's some differentiation there. So I think that if you're thinking about office, you got to look at the markets. We're not huge secondary office market players, so like a Poznan, it's just a place that we haven't gone, wouldn't go. Krakow, I would say we've continued to look at it. We didn't want to be first in. I think there's some real substance there, even though it's a market that you got to understand. And overall in Central Europe, even if you're in Warsaw, I think it's a market you need to understand. So it is active asset management. I think retail is even more active asset management because it's always things are churning, concepts are changing, the retail environment's changing. But then right behind that, I'd say especially right now, the office market, you really want to know. I'm not going to go into each sub-market or each different country, but we took a view on Hungary 2 years ago and we went long with what we think was really the best available office stock in that market. Bought it at $2,200 a square meter. They're at cycle low rents. Yes, it's been long-term a challenged office market, and the politics don't help it. But fundamentally, that is still an important part of Central and Eastern Europe. It's highly educated workforce, and it's going to be relevant. So I just think you got to really look at it from kind of the top down, the bottom up. Know the four corners you're buying in, and be ready to be active with the way that you manage it. So I don't think you should just, I understand why you kind of take shifts and say, I'm seller of office and what have you generally, but I don't think we look at it and say office overall, no. Warsaw, oh, there's all this supply coming. I mean, if you really get underneath the numbers, it shouldn't have been news to anybody. I mean, it was there, it was definitely coming. But that market is at about overall 11.5% vacant right now. The amount of supply that they've had, it's shocking. Okay, that's a healthy market by almost anybody's standard. If you go sub 10 on vacancy, you're in a healthy market. Yet the rents in the market, all the landlords are afraid, and the tenants have had the saber and said, no, I'm not, I can't, risk losing this guy. So they've kept rents really low. Now, again, it doesn't mean everything's perfect there. It's been really frustrating for people. But only market that's had positive absorption forever.
Yeah.
Positive absorption forever.
It's expected to continue. Yes, there is. You can look in the city and go, there's a lot of towers planned. You can look from site to site and projects ongoing or planned. But how many towers have been built in Warsaw in the last 10 years? Proper tower. Pretty much Rondo is the only one. Now, you've got the Spire, Galamco coming on fairly soon. But the pain in Warsaw is in the grade B stock. And we have a lot of grade B stock which was built in the late 90s without raised floors. Raised floors only came in the early 2000s. So that's the opportunity for occupiers now, and that's what there has been a lot of movement. It's out of the older stock into new stock on very nice rents, great incentives. So the grade A stock vacancy is actually a lot less than the market. The market only ever quotes 12, 13% going up, but grade A stock is around about 8, maybe less than 8%. So the demand is there, and the take-up and the absorption is good, but it does have this image of pipeline, oversupply, falling rents, incentives going up. Pick the right assets though, and you can get in the right locations. There are good opportunities there.
And if but nevertheless, I mean, you should see how much of new office space is supplied to the market over the next 2 years. I mean, you cannot ignore that. Yeah, even if you have a positive take-up, you cannot simply ignore that. And I mean, whenever you open one of the magazines, you see a new tower which is announced. And I mean, for example, when Skanska announces a new tower, you can be sure it will be built because they don't need any financing and they always build on spec. So this tower will come, and it's another 120,000 square meters here, and you can simply not ignore that. And besides that, what you also see, especially in Warsaw, is you see a shift from the, let's say, from the sub-markets like Mokotów to Wola, for example, which is due to the new underground, which is being built here. So you always have to be very careful. I mean, it's not only the CBD which has a major supply; it's also the smaller sub-markets which clearly change here. I mean, whenever you go to Mokoto, for example, you will find yourself in a traffic jam. Being it at 8 o'clock in the morning or at 8 o'clock in the evening, at least that's your feeling. So people try to get around that, and you have almost no metro station there. Yeah. So that's also changing. This is also something, let's say, investors have to be very cautious about. And besides the fact that in Warsaw you only have a standard of 5-year lease terms. So after 5 years, the building is not really old, but usually a tenant moves out to a newer building. And that's when what Gudrun just said, when the asset management should really set in. And I think this is becoming more and more crucial. And that's also what the banks are looking for. I mean, you have some investors where you exactly know, they are good in buying, but they're probably not as good as in managing. And this is something you should really be focusing on in the future. Do you have the right asset manager? Do you have the right leasing agents here? Because you will see vacancy in your buildings. Maybe it's not a vacancy of 30, 40, 50%, but it's a vacancy of 20, 25%. Here, and at least this is enough to breach the soft covenants with the banks here, and you get a distribution lock. So, I mean, I think it's not that easy. I mean, you're fully right. If you look at Class A vacancy in Warsaw, it's certainly below 10% here. Yeah. But, I mean, all the new stock which is built now is Class A in the future, or more or less here. So this will increase. And so what I think as a banker, you should be very careful over the next at least 3 to 4 years minimum, because all the skyscrapers which are announced today will probably be finished in 3 years' time. Here. So, I mean, when we at the moment are financing a new office building, we carefully look what is the WALT, the weighted average unexpired lease term here, how long is it, who's the asset manager, what's the location, is it in the right or in the wrong location here, and these are points which we thirdly take into consideration by saying, okay, you can finance such kind of office buildings, but on the right terms and with the right, let's say, sponsor and parties.
But there's a lot of move also in the Class A, because Gordon and our company moved last year, or within the last year, to another office building within the A class range, or from A minus to A plus. So within the vacancy, even it's single digit, there's a lot of move.
You have a lot of cannibalization. When KPMG is moving out of one tower, moving into the Gdansk building, here it's clear cannibalization. And this is, some of the developers, they do it only via the price, via the rental level here, and this is also driving rental levels down.
It's all true.
And that's. I mean, you see the headline rents, but no one is actually paying any headline rents anymore. And I was wondering when you said, the rents are going down by 2 or 3% only. I would say it's rather 10% if you ask me, or 10, 15%. Here, not on headline, but at least on net effective.